Hi, welcome to a video by Samsung Asset Management in Hong Kong. My name is Gary Ng and I'm joined here by Chen Feng. We are the portfolio managers for the Samsung China 2.0 Mainland Fund, which focuses on investing in Chinese companies listed in Shanghai and Shenzhen, otherwise known as A-shares. In our daily work, we study companies and observe many interesting trends in this dynamic and fast-growing economy. So today, we would like to share with you three key messages. Number one, longer-term investment opportunities that we see in China. Number two, the market outlook in 2021. And three, how our fund aims to capitalize on these trends. To give an overall context, if we think about China's economic development over the past 20 years, the economy has evolved from an era from manufacturing simple consumer electronic products and building basic infrastructure into an economy which is now adopting the latest technologies across a whole range of industries at a very rapid pace. In 2019 alone, according to the World Intellectual Property Organization, the WIPO, its Chinese office received a total of 1.4 million patent filings, as indicated in the blue line of the chart. Over the past 10 years, the number of patent filings in China has grown by 4 times and is now more than the US, Japan, Korea, and European Patent Office combined. We think these patent filings reflect the scale and breadth of innovation that's ongoing in China across a wide range of industries like 5G communication services, semiconductor chips, artificial intelligence, electric vehicles, solar energy, innovative pharmaceutical drugs, and many, many more. All of these innovations are happening all at the same time and present structural, multi-year, and high-growth opportunities for investors over the next few years. We believe China is rich with these investment opportunities, and in the Samsung China 2.0 Fund, we seek to identify high-quality and well-managed companies in these high-growth industries, which have strong competitive advantages and robust business models. By carefully selecting well-managed companies with the potential to compound on earnings, investors can stand to benefit by capitalizing on these trends over the medium term. I will now hand it over to Chen Feng, who will share with you the investment outlook in China in 2021.
Thank you, Gary. Hello, my name is Chen Feng. As we come out of the pandemic in 2021, China's economy is forecast to increase by more than 8% this year, so we see a very stable overall macroeconomic environment. Up to 100 million people have already received vaccination in China, and we expect the pace to maintain. Recently, China held the National People's Congress, and in its 14th five-year plan, the leadership pledged to double the population's average income by 2035. They also stressed the importance of carbon neutrality, technology innovation, and consumption upgrades as the main drivers of the future economic growth. These are also the sectors we focus on for our fund, which Gary will elaborate more later. Looking into the rest of the year, we expect China's economy will continue its strength, mainly thanks to private consumption rebound against the low base of last year's pandemic slowdown, especially in first to second quarter. We have seen positive signals in the service consumption industries, such as hotel booking and domestic air traffic recovering, as evidenced by strong booking for the upcoming May Labor Day holiday. GDP growth will gradually moderate from second quarter on normalized comparison base, but we don't see much downside risk to the 8 to 9% GDP growth for the full year 21. On the other hand, robust economic recovery calls for policymakers to consider gradual normalization of stimulus. Total social financing year-on-year growth is likely to gradually tighten in second to third quarter, but will stay above nominal GDP growth of around 10%, providing ample liquidity to support economic growth. The central bank governor recently said that China's monetary policy is in a normal range and has room to provide liquidity and appropriate interest rate levels. So in conclusion, we are still optimistic about the overall macro picture and expect the normalization of stimulus policies to be gradual. Policymakers will still have plenty of room to ramp up stimulus if the economy experiences a soft patch. Also, we want to talk to you about the recent value rotation, which is a hot topic this year. As you know, US yield was increasing at a rapid rate. Most recently, it has passed 1.7% level due to higher inflation expectation and the economy reopening. US yield curve affects the asset pricing globally of all risk assets, so all the investors, including us, are watching the rate very closely. This has been a key reason for global value sectors to outperform recently. In China, the situation is slightly different. We see modestly higher inflation expectation as well. However, the China yield curve is much more stable versus US, as the control of the virus situation was relatively quick last year, and there were no large outbreak after first quarter 20, so policy easing last year was not large. China A share market also see some shifting to value sectors so far this year. However, the shift we believe will not last more than 1 to 2 quarters, as the value names recovered relatively quickly past the 2020 pandemic. This year, the strong EPS growth for the value sectors will mostly be in the first quarter before normalizing. So in our view, the growth sectors will likely take off again in late second quarter to third quarter. Next, I'll pass to Gary to talk about our fund's aim to capitalize on these longer-term growth trends.
Thank you, Chen. In terms of constructing the portfolio, the strategy is more driven by stock selection on where we see the opportunities on a bottom-up basis. In the chart here, we list some of the sectors where product penetration is low and have the potential to grow to multiple times of its size over the next 4 to 5 years or so. For example, solar energy benefits from the Chinese government's goal in decarbonization, and it targets a peak in carbon emission by 2030 and carbon neutrality by 2060. As such, solar energy is expected to play a key part in achieving this goal, with its share of the power generation mix expected to double by 2025, and an even bigger goal beyond that. We also see similar growth potential in other areas such as semiconductor localization, electric vehicles, and software companies, and many others in China. With strong growth potential in a wide range of sectors over time, we believe in positioning in companies that benefit from these trends and whose earnings can compound over the next few years. As history has shown, a company's intrinsic value and share price tend to follow its earnings potential, and the expected compounding of earnings can lead to attractive returns over time. Having said that, risk management is also a very important part of our investment process. As we know, China is a very vibrant and competitive economy across industries. The sector leaders of today can go through challenging periods and may get overtaken tomorrow. This is why we believe in investing in industries where entry barriers are higher and in quality companies with differentiated competitive advantages and whose business models are robust enough to withstand competition. Also, growth stocks don't often outperform in a straight line. As China recovers from the pandemic, cyclical sectors may be favored over growth stocks in some parts of 2021. This is why we believe in the importance of having a diversified portfolio to not only capture growth in fast-growing industries, but also in stable, growing, and well-managed companies which benefit from the economic rebound as well. To recap, we believe China has developed into one of the world's most vibrant economies in the world today. As the number of patent filings show, innovation is flourishing in China, and this presents investors a wide range of high-growth opportunities in multiple industries in the medium term. In 2021, as China moves out of the pandemic, it is expected to report a high, healthy GDP growth of 8 to 9%, providing a good basis for fiscal and monetary policy stimulus to ease gradually to sustainable levels. Recently, the government's announced 14th five-year plan aims to double the population's average income by 2035, and also emphasize on carbon neutrality, technological innovation, and consumption upgrades as the main pillars of future economic growth. Our fund aims to capitalize on faster-growing trends which can compound in the years ahead, while managing our risks through investing in industries with high entry barriers and in companies with robust business models and differentiated competitive advantages. We also diversify and balance the portfolio by overlaying it with a selection of stable, growing, and leading companies which we believe can also benefit from the economic recovery. So that's all for our key messages today. We hope you found this video insightful. On behalf of Samsung Asset Management, we thank you for your attention.